Well, welcome everyone, and thank you for joining us for today's webinar. Today we're going to be talking about building a budget, and we're specifically going to be looking at how we take a bottom-up approach to doing that. So we've got a fair bit of ground to cover today. If you have any questions as we go through the webinar, I'll invite you to put those in as a question as we go. If there is questions, I'll pause on each slide and we can deal with those as they come through. Hopefully we might get a bit of time to actually go through some questions at the end as well, but encourage you to actually ask questions as we go, and we'll clarify any issues that aren't making sense to you. I want this to be a really practical approach, and we're going to go through step by step in quite a bit of detail. So hopefully there's something here you can take away and have a much more successful budgeting process going forward. So a little bit about me before we start. My name's Tanya Titman, and I am BDO's Head of Strategic Innovation. So I've been an accountant for many years and have worked with business owners across the board, from small businesses, startups, right through to large companies. And budgeting is one of those things that I find isn't done all that well. A lot of people don't tend to do a budget. They don't tend to trust the process. So I have a very, I guess, a very passionate view about financial education and helping empower business owners to understand more about numbers and to engage in that process so they get a better result. And it leads to a much better collaboration with your advisors, with your bookkeepers and accountants. And I think you get a much better result through doing that. So today we're going to take you through a process. It's something that you can work collaboratively with your advisors on, but you know, I really feel that it's something that you have to take ownership in. So welcome to everyone who's joined us today. It's great that you're actually investing some time in understanding more about your numbers, and I hope that this helps you a little bit on that journey. So what we're going to cover is firstly just talking a little bit around getting your financial information in the right format. It's a really good place to start because you need to understand and have your financials in a state that is actually informative and is going to help you in building a better budget and having a better budgeting process. So we're going to talk a little bit about that. I have some very strong views on what your financial information should and shouldn't look like, and I'll share some of the tips and tricks and many of the mistakes that I see across many businesses in terms of why their information isn't giving them the right story. We're also going to go through and explain this bottom-up budgeting process. So it's certainly, it's turning it on its head a little bit. Many people start and build a budget just by referring to last year's numbers and starting with revenue and working their way down. I'll explain to you why that isn't necessarily the best approach. And I'll take you through the 8 steps that you actually need to do to build it accurately. And we're going to also share with you some pathways and tools that we can assist you in that journey if you need more support. So firstly, a little word about budgeting and why it's important. I think it's one of the most important tools that you have at your disposal as a business owner. So I'm fascinated by the number of people that don't actually engage in this process. I think that if you don't have a good budget in place, that you are essentially winging it, you're flying blind, and you don't really have a clear financial strategy. And the difference between those that do and those that don't is monumental. So when you have a clear financial strategy, when you have clear goals and accountability to it, the results that you get are significantly better. We know this through many years of working with business owners, and that link between financial literacy and business success is very strong. So investing this time in actually understanding a budgeting process and building it to be a better process, I think it is great. It certainly gives you a roadmap for your business. It helps give you a measure to sort of drive success and measure yourself against. And it's certainly the starting point. So we're a little bit into the financial year, but it's not too late to revise your process and look at how you're doing budgeting for this next financial year. So before we start, I would just like everyone to give me an indication. So do you currently prepare an annual budget in your business? Just a simple yes, no answer. Just like to understand who actually is doing a proper budgeting process currently and who isn't. So take a moment if you can just answer that poll for us. Okay, thank you, everyone. So why don't businesses actually do a budget? I guess why people don't tend to do it is because they probably look at it as crystal ball gazing. We don't actually, look at understanding the data that we're using. And what tends to happen is because we don't have a great budgeting process that's really robust and based on really good data, it becomes irrelevant. So the further we go into the year, so we might start with great plans, the further that we go into the year, it means that we actually get this quite a large variance from our budget, and so we disregard the information and we drop it. When we actually have a strong process, it does work a whole lot better. The other thing that I find is really key to why budgeting doesn't work is it's done by someone else. So I've seen many accountants and business and bookkeepers put together budgets for their clients. And that's great, and it's better than nothing. But the problem is the business owner isn't engaged in the process. So when you hand it off to someone else, you don't tend to engage. You're not really committed to it, and if you go off budget, then it's not your problem. Someone else got the data wrong. So we really want to change that approach and get you part of the process. And we know that when you are part of the process, we get a much better result because you have ownership in that budget and you have accountability to it as well. So let's talk about getting your data right. This is step one in our process. And it's really the key to starting a great budgeting process is you've got to get the right data. So what does that look like? Well, the basics, you make sure that your information is reconciled, make sure that you have, clear visibility and you can access your information. Many business owners don't even know how to get access to their financial information. They're reliant on a bookkeeper or an accountant to give it to them. I really have a very strong view that you have to be empowered with your financial information, and really important that you can access it. So you might not be the one doing the actual coding and doing the actual bookkeeping piece, but you certainly know or need to know how to be able to log into it, how to engage with it, and make sure that your data is correct. That's your responsibility. Step two, we're going to review the historical information. So what this looks like is actually having a good look through the last 12 months of your profit and loss and balance sheet. Now, if it's not something that you're looking at on a regular basis, then it is something that I would highly recommend you start engaging with. So have a look at your profit and loss. Look at each line item. Does it make sense? If it doesn't make sense, find out what it is. Ask questions. Be curious about your financial information because this is your data and you need to engage with it. Often many businesses look at a profit and loss statement because that's the one that tells you have you made a profit or a loss, but they don't look at the balance sheet. And your balance sheet is as important, if not more important, than your profit and loss statement. So again, get out a balance sheet, go through every line item. If there's anything on there that doesn't make sense, then please ask your bookkeeper or accountant about it. Your balance sheet is something that you should be able to verify every single line item. And if it's correct, then you know that your data is correct, your profit and loss is correct. If it's not correct, then there could be errors in your data. So it's a really important piece to understand. So review it, that's our first step and really important in the process. Now, I'm going to introduce a concept here, which I think is really, really important when you're looking at your data, and that is that you can actually have multiple views of your financial information. Now, many accountants will put together a profit and loss statement for you as part of the year-end process, but the problem is that that is for the purpose of constructing a tax return, typically. So you're going to have a whole lot of tax adjustments in there. You're going to have a whole lot of accelerated depreciation. You might have additional superannuation. The data is actually constructed from the point of view of preparing a tax return. Now, as a business owner, that's great. You'll know in terms of how much tax that you'll have to pay, but it actually skews your true operating position in a business. So what I'd encourage you to do is to use your accounting software, to work with your accountant and your bookkeeper to make sure that you construct a view of your profit and loss that actually informs you of the true operating position of your business. I'm going to take you through a few tips in terms of what that looks like, but it is important to understand, and many business owners don't actually understand this, that you do have the ability to have multiple views of your data. So you can have a view which informs your tax return, but you can also have a view of the same data with different categorization that tells you what the operating position is of your business. So it's speaking to you as a business owner, and it's going to help inform you of your financial strategy. So when we're going through building that report, I'll just go back and mention a couple of things there. Cost of goods sold is the key section. I'm going to go into this a little bit further as we go through our webinar, but it's the one that I want you to really have a focus on as you go through and think about, have you truly allocated the true cost of producing a product or service in your cost of sales section? I'm going to go into a little bit more detail about that and take you through what things might not or might be in there that you might need to reallocate, but that's a really key piece to understand in this process. All right, so we've done our review of our data, we know it's reconciled, and we're going to look at trying to reallocate and tidy it up so that it's actually speaking to us as a business owner. And the next step then is starting the budgeting process. And we're going to do that from a big picture sense. So we start at the bottom because we're looking at what is the profit that this business should be able to make. When we start at the top, we tend to refer to last financial year. We might do a slight increase on our revenue, and then we flow down the page to say what the profit is likely to be. Now, I'm challenging that to say, actually, let's start at the bottom and say, what should our profit be? And what were our expenses, and how are they going to change for the next 12 months? What are our cost of goods sold, and how are they going to change? And then when we add those three things together, we get to our top line revenue. So when we take this bottom-up approach, it actually challenges the business model to a larger degree. So we start looking at what should our revenue be in order to generate this profit, instead of referring to historical data to shape what our revenue is going to be for the next financial year. Now that's great. It actually gives us a little bit of a challenge, because then we end up with a gap in our revenue that we've got to work out how we're going to close that gap, and how can we build more revenue into the business. But that's great, because a financial strategy relies on you testing and looking at your business and looking at how you might be able to evolve it better going forward. So let's go into a little bit more detail around some of this. So firstly, the net profit. So what is the number, and how do we know what profit we should be targeting? Well, it's really important to consider your profit is your return on investment. When you look at how much time or money you've spent investing and building a business, then you've got to consider what is a good return, and that takes into account the risk that you're taking as a business owner. You certainly want to get more of a return on your business than what you would do if you had a passive investment, and that money was sitting in some sort of a passive investment, whether it be in shares or whether it be in property or in the bank. So you want to make sure that you get a good enough return out of that business. So sometimes when you do this big picture planning, it's good to just start with a bit of a blank canvas and think about what could or what should this business be able to generate in terms of a profit. So don't think from a historical perspective in terms of what profit I did last year in the business. It's actually looking at ideally, what should this business be able to generate? So think of it from that perspective. So then we're going to look at your operating expenses. And when we go through these, it's important to consider Have you got everything allocated? Are there expenses that maybe you've had in the last 12 months which aren't going to be recurring for the next 12 months? Have you actually included a salary for yourself in the business? So when you're doing a budgeting process and planning it and doing this bottom-up approach, really important to consider, if you're a working owner in the business, that all of your salary is taken into account, and that you don't even, and this is regardless of the fact if you take this as a dividend or a drawing or something else, you've got to take the salary into account. Because you are a working person in that business. So if you weren't working in the business, you would have to pay that salary to someone else. Important to test your business model to make sure that you can both achieve a salary for yourself and a profit out of the business. When you're going through and looking at operating expenses, you've got to consider, are any of these operating expenses needing to be reclassified into other areas of the business? So if you've got, in that operating expense section, if you've got some tax planning, some accelerated depreciation, any superannuation, I like to show those below the line as non-operating expenses so that we're not skewing our operating profit for the business. Also looking at building in classification of your expenses into areas such as marketing, into areas of staff costs. You might have administration expenses, occupancy expenses, so classifying them in groups so it becomes easier to find expenses and to look at trends. And my favourite is adding a section called discretionary expenses. And what discretionary expenses are things that are not necessary for the operation of the business. They might be the things that you spend money on when times are good, but essentially they're not needed for running the business. And often it's what I call the fat in a business. So consider adding a discretionary section where you put all of those expenses into, because when times get lean, it's the first place that you go to try and cut back, and that's a much better place to start rather than starting to cut staff out of the business and do things which might impact on your business strategy. So look at the operating expenses and classify them into an order which is logical, and also consider things that may be in there that possibly don't belong and aren't needed for the typical business operations. When we're going through looking at your operating expenses, there's some examples there on screen of ways in which we need to, I guess, break them up. One of my favorites that is on there is software subscriptions. So many businesses now, because software as a service is something that it's really easy to subscribe to, we often sign up for software online, and we can have many software subscriptions running. And if it sits in one account called software subscriptions, it's not visible. We don't see the wastage. We don't see and can't actually analyze, are we using all these software subscriptions? So it's one that I really like to split out and have a separate line item for every piece of software that you have in the business. So you can have a line item for Dropbox, you can have a line item for your Xero subscription, you have a line item for any of these subscriptions. So a separate line item in your financials, because what it does, and I find this is an area where there's a lot of wastage in business, because we sign up and we forget about them, and then we don't actually think about, are we still using this piece of software in the business and do we really need it? So that's an area where you can find a lot of savings when you actually put it under the microscope. So that's a good one. And any other expenses that, or any other categories in your business that you might have a similar type of, I guess, expenses such as telephone, mobile phones, even motor vehicles, where you want to split it out to put it under the microscope to see whether you might have some savings there going forward. So do the analysis, work out where you can save money going forward in the future. Now, my favourite one, cost of goods sold. For many businesses, when we build a financial strategy, this is the area that I find is probably the most underdone in terms of getting it right for direct costs. And most businesses, if you're service-based, often I find that there's no allocation in cost of sales of any costs at all. In inventory-based businesses, we tend to have our inventory and our cost of sales sitting in there, but that tends to be about all. So what I would challenge you to do is have a good look through your expenses and find out what are the things that are directly related to you delivering your service or your product to market. And you need to show these in the cost of sales section. So these are things that are going to typically increase as your revenue increases. It tends to have a direct increase with it, so they're influenced by revenue. And the ones that tend to get overlooked are things such as merchant fees. So all the payment gateways that you might use in your business, they're a direct cost of providing that service or product. So they should be sitting in your cost of sales section. If you're a service-based business, you would have direct wages because the cost of actually providing the service are those staff members. So you may need to split your wages between direct and operational wages. So that is another area, and your accounting software can do this quite easily. So it's a matter of getting assistance from your bookkeeper, from your accountant, and actually getting that direct or indirect allocation so that if we get our cost of sales right, the benefit there is that all of a sudden we can start influencing pricing strategy. Once we understand the true cost of the product or the service, then we can start looking at, have we got the right pricing strategy in the business? How do we need to change it? And again, that feeds into our financial strategy. Now I'll pause there just for a moment if there is any questions. If anyone would like to submit any questions, we did have a couple submitted prior to our session today, and I'll just take a moment to address a couple of those as we go through now. But one of those was around companies are putting together a number of budgets at the beginning of the financial year and then every 6 months, and why would this practice be beneficial, and what are the negatives of doing that? So when we do this budgeting process, it's important to set out, and with all the information that we now know, to set our budget for the next 12 months. But often something might happen throughout the year that means that we have to reforecast. So typically, we don't want to change that budget, but if things happen of a significant nature, there might be some sort of market influences or some additional opportunities that we didn't know were going to come about at the start of the budgeting process. That would cause us to need to reforecast and to rebuild the budget based on that new information. But other than that, there generally is not a need to reforecast. It's only going to be something that you would typically look at on a quarterly basis, but only significant events such as a change in the market, a change in service offering, a change in market opportunities would cause us to need to revise that budget. But it is important to keep monitoring it throughout the year to make sure it is still relevant based on the data that we have. And the other question that we had there was what constitutes good budget planning? Should you be overestimating and being optimistic, or should you be underestimating your budget? Well, I think that a good budget is one that is based on really good data. And, you know, in order to do a great budgeting process, you've got to do the groundwork in terms of looking into the historical information, understanding it, making sure that you're basing your budget on all of the information that you have now, and you're using that to form and shape what your business strategy should look like for the next 12 months. So it's got to be done in conjunction with business strategy. So you need to look at what are the objectives that you're wanting to achieve this year, how does that change our sort of financial position, and we've got to factor all of those things into the budget. So it is a really extensive process, and the more time you put into it, the better result you will get as a result. I don't think that it's good to underestimate and then, you know, come in at the end of the year and give yourself a pat on the back to say that that's great, we did well. I think that it needs to be realistic. So you don't want to overshoot the mark and just make it unachievable, because then you'll stop looking at it. So it really is about trying to predict with as much information as you have and get the best results. So you know with some certainty what it's going to look like from a financial position for the next 12 months. Okay, so when we're looking at just closing out on that cost of sales, so there's no questions from anyone, so I'm taking it that everyone understands really well what we're talking about, so that's great. When we're going through with the cost of sales section, I can't stress enough how important it is to get this right. And, just think about it. I've got some examples there on screen of all of the things that may factor in to your cost of sales section. So really, really important to get this right, because the next thing we're going to be delving into is that the revenue gap. And if we understand we've got a revenue gap in our budgeting process, so we want to achieve a certain profit, and as a result, that means that we've got to increase our revenue significantly in the next 12 months. In order to do that, we could look at our pricing strategy. We can look at how we can get more volume through on our sales, but there's always a price and volume relationship when we're looking at revenue. And so in order to do that properly, we've got to understand what the true cost of providing the product or service to market is. And that is where we need to get this cost of sales section really, really accurate. And sometimes when you do that full allocation, it doesn't look great, and maybe your gross profit's not looking so healthy anymore, but at least we know the facts, and then we can use that to help inform how we build a better pricing strategy within the business. So on that note, with revenue, when we're looking at revenue, this is where we start to understand, okay, what is our revenue target? What did we do last year? And therefore, what is the revenue gap? How are we going to fill that gap? What are the strategies that we're going to do to be able to close the gap and achieve that revenue, if ultimately that is the bottom line profit that we want to achieve? And one thing that's really helpful when you do look at revenue is breaking it up into specific line items. So anyone that has one line item in their revenue saying sales, I would challenge you to break that up into further detail. So you could break it up on product lines or service lines. Ideally, you want to be able to get a price and volume relationship for every item in your revenue. And if you can do that, then we can start building quite specific strategies around each of those revenue lines. And that helps to break it down and to make the revenue gap more achievable in terms of closing the gap and having a clear pricing strategy around it. So revenue is a really important one to consider. How do you need to break it down? You can build subsections into it, so you can have different categories. You might have different locations, but make sure that you've got a very clear picture in what that revenue looks like. So just to recap on that process, we're starting with the profit. What is the profit that you want to make? Then we're looking at what is the estimate of our expenses over the next 12 months. What will our cost of sales be looking like, and what is the revenue? And when we do that cost of sales, when we're doing it in just a big picture sense, the thing to take into account with your cost of goods sold is that you typically will have a consistent relationship between cost of sales and revenue. So whatever your gross profit margin is, then you're going to try and keep it a fairly consistent margin when you're building your budget. So I've just got a question that's come through here around software subscriptions in operating expense, but also there was software subscriptions that may come into a cost of goods sold. So what's the difference, and when would you have software in one versus the other? So great question. And the answer to that is, if you were a business, say a service-based business that was offering a service, and part of that service offering was having the delivery of a software piece. So for an accounting practice, for example, they might have 0 subscriptions as part of their service delivery. That would be a cost of sale for an accounting practice. If you're a marketing business and you're delivering some services around social media, you might have the actual social media software platform that you're using to deliver those services for your clients as part of your cost of goods sold. So where there's a direct relationship between the cost of goods sold or the service and the expense, you want to get all of the expenses that relate to delivering that service into your cost of sales section, as opposed to if it was a software subscription for Google or for Microsoft, which is your operating expenses within the business. So it's trying to get that direct relationship where it is a part of a service offering. So another example or question that we've got there is when we break down the expenses, do we mean creating more specific accounts on the chart of accounts? No, that's the great thing about our accounting software. So there's many platforms out there. We love Xero. It's a great platform that actually helps to make it really easy for business owners to get in and build these reports. But every accounting platform has the ability to do this. And what we're doing is not actually creating more accounts in the chart of accounts, but it's how we can take the report and move them into specific sections and create subsections. Now, the exception to that is where I talked about software and actually building a separate line item for each software piece. If currently you've got one item in your chart of accounts called software, and that's where you put all of your software subscriptions to, then yes, you would need to create a separate chart of accounts code for each software piece. So it depends on how your data is currently split, but in terms of reviewing your financial information, that reviewing the chart of accounts is certainly a part of that process. If you don't have the detail already and it's all just quite, I suppose, summarized into various accounts, you might want to split it out so that you can get better data to inform your decisions. All right. Now, we're going to move on to talking a little bit around this revenue gap. So we've touched on the building this big picture budget from the bottom up. Now we're going to go into a little bit more detail. And so looking at the revenue gap, this is about, let me give you an example. If we say that we want a profit in the business of $200,000, and that means that my revenue has to go from 1 million to 1.5 million, and say, okay, well, that doesn't seem realistic. How on earth am I going to achieve that in order to achieve the profit that I want in the business? Well, what I would suggest is you don't know whether it's realistic or not unless you actually delve into the data and look at the plan. So if you break down your revenue line into various sections and then you look at the price and the volume month on month in terms of what is possible, it's amazing how much revenue you can generate with that level of detail. Often we find that businesses will just go along with the same strategies that they've always had in the past, but this is a great opportunity for you to really look at your revenue and look at your pricing model, look at your business model. Do you need more products, more services to generate that extra revenue, or do you actually need to tap into your existing customers? There's so many things that we can do to close that gap, and it's all around your business strategy. So there's a very close connection between your financial strategy and sort of what you're building with your business strategy. And this is where it all comes together. So don't just take last year's revenue and a 10% increase and think, well, that's what it's going to be. Actually test the data and look at what could be possible and whether that gap is realistic or not. What is your business strategy around rolling out and growing the revenue over the next 12 months? And you might find that that gap is realistic or it's not. Now, if you find that, well, there's no way that I can fill that gap, then you've got to go back to that big picture budgeting and revise your profit estimate, because you're not going to be able to achieve that level of profit unless you can cut expenses. Then, so it actually becomes a little bit of a process where you build that big picture, you test all of the pieces of it to get to a point where you're comfortable that, yes, this is actually achievable. So just a question that's come through on that bottom-up approach is when we have a bottom-up approach and ensuring you pay yourself a salary, how do you decide how much profit is sufficient enough? And again, that's a great question. It's very dependent on each business, but the way that I look at it is when you consider what your investment has been in the business. Now, if you're someone who's never taken a salary in your business and you've been building it for the last 5 years, then what I think is useful is to actually say, well, what would have been a realistic salary for what I've done over the last 5 years? Because let's say it's $100,000 per year, you've been building it for 5 years, and you've invested $500,000 of blood, sweat and tears into building this business. And so that might not be that you've actually paid and bought a business, but you've actually put that level of investment in through your own personal exertion. So what is a realistic return on that money? Had you have put that money in the stock market, how much return would you have got? And look at it from the point of view of, for the risk that you've taken in building this business, what is a realistic return on that investment? And from my point of view, I think that you should be looking at something relatively significant, probably in the 20 to 25% return on investment for the risk that you take as a business owner. So that gives you a starting point to build your budget from the bottom up. Now, it might be that you can't get to that, and with your salary included, in the next 12 months, but at least it gives you this overall picture and an idea of what the business has to do in order to be a commercially viable business. And you've got to start working towards that. So it might not be realistic in year one, but now you've got quite a clear plan, and you've got to start pulling the pieces of the business apart to build the plan out to essentially get it to that point where it is commercially viable. Because when you have a business, it's really important that you do pay yourself a salary for if you are working in the business, and it's also very important that you can generate a profit. When you can start to do that, you've actually built an asset, not just an income stream, and then you can actually start to get some real returns for your efforts in terms of what you've built. All right, so talking about our revenue gap, just to clarify, so that's whatever the revenue target is that we've come from this bottom-up budgeting approach, less last year's total revenue gives us what our revenue gap is. That's what we're trying to fill in terms of building this financial strategy over the next 12 months. And breaking it down piece by piece, it's actually, I'm constantly amazed by how you can fill the gap. But you're looking at the number in isolation. Sometimes it feels like, well, there's no way on earth that we could possibly do that. When you break it down in all the pieces, and we start to look at strategies around each revenue line, then it's actually quite incredible with some really good data and some really good insight in terms of what's possible. So I challenge you to actually look further into that. So step 5, when we're building the budget, so we've done the big picture piece and we've looked into the revenue, we've now got to start building out all of the expenses. So we know the historical information, and when we start projecting out for the next 12 months, we go through every single line item and we're going to challenge, do we need that going forward? And what is going to be the expenses month by month? Now, really important to take into account seasonality. Don't just take the expense, divide it by 12 and put 1/12 in each column. Look at seasonality in each of the expenses and make sure that you factor that into your budgeting process. If there's any additional expenses, so if you're looking to expand the business, you might be looking to move premises, then you're going to have to take into account that extra expense into your operating expenses. So consider what things might change in your business over the next 12 months and make sure you take those into account. And again, include a salary for yourself in this process. Now, if you are choosing to take your salary in a different way, whether it's taken as a drawing or it's taken as a dividend, I would still like to incorporate it into this budgeting process to make sure that I suppose you've got a clear picture on what your profit needs to be with your salary included. Now, if you take it out and you're not paying yourself a salary throughout the year, it just means that the profit will be slightly higher in your actual accounts. But certainly it's an important piece in terms of getting the commercial viability around a business. All right, step 6, understand the relationships between cost of goods sold and revenue. So this is one I've been harping on a little bit, but it is so important. And getting the correct cost of goods sold. So when we're forecasting out and we understand what the relationship is between our cost of goods sold and our sales, you need to keep it fairly consistent moving forward. So this is something that you should be tracking over time in terms of understanding your gross profit. And so that is your sales less your cost of goods sold equals your gross profit. And what that is over time, the percentage between your gross profit and your sales will stay fairly constant. So if you're projecting out in your budget that it's going to move significantly, then that probably flags to me that there might be an error in your cost of goods sold, and you'd need to look a little bit closer into that. So we don't generally see, they move in line, and as it goes through, I'll show you this next slide, they actually move fairly consistently together, because as you increase revenue, typically your cost of goods sold will increase also. So if you're budgeting and your budget shows a big variance in terms of what you've produced in the past, then that's a flag to actually go back and have a look at that section. Step 7 is about staff capacity. Now, when we're growing a business, it's really important, and particularly when we're targeting additional revenue, to consider, have we got the correct staff resources? So actually going through and looking in detail at your costs in terms of your staffing and resources is an important part of the process. So don't underestimate what that's going to be going forward. Understand the structure of your business from a HR perspective and look at how that might need to change over the next 12 months in order to achieve the goals that you've set. So is it realistic that you've got this big lift in revenue, but you actually haven't factored in additional staff to help cater for that? So often people underestimate the resources around staffing that are required in financial strategies. So take some time to actually look into that in a little bit more detail. And the final step is actually going in and getting that finalised budget into an accounting software. Now, many accounting platforms will have budget managers such as Xero, MYOB, QuickBooks. They all have budget tools in them, but the budget tools won't allow you to do the amount of testing and querying and poking and prodding into the numbers that we've just gone through. So what I recommend is you do the budgeting piece outside of your accounting platform in terms of looking from the bottom up and drilling into expenses and doing all the what if scenarios. And when you're happy that you've got the right numbers, then you take those numbers and put them into your accounting software. So you've done all of the analysis, you're confident on the numbers and all the inputs and into your budget, and then you can put them in and track yourself against them month on month. So once it's in there, it's important to look at it. Every month you should be looking at your budget versus your actual in terms of your profit and loss. And as we said earlier, you need to review this on a quarterly basis. If you're starting to move significantly from your original targets, then you might need to reforecast. And typically you want to be tracking that on a regular basis. This is a really collaborative piece, and when you have a great budget in place and you've built it with your advisors, I think it works really well to then catch up on a monthly basis and sit down and review and test and query the data and why haven't we hit that target and what's gone wrong in this particular expense category, why have we overspent. Just understanding why things are not as they were predicted to be is a really important part of the process. So it is a really extensive process to get a budget right. Some options for assistance. So what we've done is put together a one-day workshop which takes you through this process, gives you the tools in which you can build it on, and after one day you've gone through the entire process, built the budget correctly, and you have a solid financial forecast and strategy that will drive your business for the next 12 months. It really takes a day to at least to build this properly, and if you're dedicating any less time than that to the process, you're probably not doing the complete job that you need to do, or you're missing the opportunities in terms of the revenue that you potentially could generate because you haven't actually drilled and queried the figures enough. So there's some great opportunities there for us to assist you and actually work you through that process. But at the end of the day, you have to build it yourself. You have to be accountable to it, and understand all of the inputs that actually go into that budgeting process. So if you would like help in that process, come along to one of our one-day workshops. It's actually a lot of fun to go through and query the numbers and test and prod them for a day. It's certainly quite a transformational piece and allows us to help you to look at your business model and potentially transform it into the way in which you can get a better profit position going forward. So I hope that that has helped in a little bit of an understanding in terms of the process. I'll take any final questions before we wrap up for today, but thank you very much for everyone for joining us, and I hope that there's some takeaways there that you can implement into your business. No questions. That's great. Hopefully everyone understands the process. And thank you very much for joining us. If you would like more information, please go to the BDO website. We have details of all of our workshops on there that we'll be conducting, and we'd love to assist you in the process.